Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for October 9th of 2023. As we get started this week, thought we'd turn our attention first to the equity markets. I have some information here for you. Obviously, the markets have been a bit tumultuous, although ending on a fairly good note here on Friday. But as we can see on the left-hand side, and these are technical indicators here. So we've got the number of S&P 500 members on the top that are trading above their 200-day moving average. And so when you think about the number of constituents being roughly about 500, you can see here clearly that less than half are trading above their long-term moving averages. And if you go down to the bottom there, you see the number of members that are trading above their 50-day moving average, which is even less. And so there is a reasonable argument to be made that equities are a bit oversold here, even with that bounce on Friday. You can see on the right-hand side a very interesting dynamic that is extremely rare. In fact, you've got the S&P 500 equity risk premium, which is basically the equity earnings yield minus the comparable Treasury risk-free rate, and you can see that that has really gone down. So bonds have become a lot more competitive versus stocks, and I think this is another indicator where you see that inflection point that's encircled in red there that just indicates that stocks are undervalued relative to bonds, and you can see the investment grade option adjusted spread there in that black line, and when you see that inflection point, obviously going back at least to 2014, you can see it hasn't happened. So this is extremely rare, just another indicator that equities might be a little bit oversold here. Here we have a slide depicting the S&P 500 value ETF, and so we talk about different factors, and not that value is necessarily cheap, but it looks oversold here. So we have seen, a definite change in leadership, kind of jockeying back and forth. I mean, for a while, it was certainly growth amongst the Magnificent Seven stocks that have that tie-in to artificial intelligence. Those were all the rave, through March through the middle of the summer, and of course that has kind of unwound itself. But value has never really kind of taken its lead, even though, as we'll see in a second, it's trading relatively close from a price earnings standpoint to its 10-year average, but it does appear oversold here, and you can see where on the next 12 months PE here on the right side versus the 10-year average. You can look at it by sector. You can see, obviously technology is still trading at a fairly high multiple, again, led by the Magnificent Seven. Healthcare and communications still a little bit above that. S&P 500 itself is pretty close. It's trading below its 5-year average, but ever so slightly above its 10-year average right now. And then down below, you can see where more of the value-oriented stocks like consumer staples, utilities, transportation, and obviously energy are trading well below their 10-year trailing averages. Now we turn our attention to small caps, which have really taken it on the chin. You can see here on the left-hand side, we've got the S&P 500 in the black line overlaid against the Russell 2000, which is in the blue, and then the pink line represents a micro cap, which we don't really talk about that much, but those are the smallest of the small. Russell 2000, we know that there are a lot of companies in that index that aren't generating profits, period. And we also know, frankly, that the S&P 500 from a performance standpoint has been led in many respects, and this goes back to April 10th here on the left, in many respects by that, that highly concentrated Magnificent Seven group that we keep talking about. But you can see the definite underperformance on the part of small caps. In fact, if you go to the right-hand side, you've got the Russell 2000 divided by the NASDAQ 100 ratio, which is heavily dominated by technology stocks. And you can see that even going back to like 1987, that small caps are intensely undervalued relative to the rest of the market right now. Now, as we continue to kind of break down the equity market, I thought it'd be really interesting to take a look at a factor analysis here. You can see the next to 12 months price to earnings ratio relative to the 10-year average. And we've already talked a little bit about value maybe being oversold, although valuations aren't necessarily cheap and they're kind of sitting just ever so above their 10-year average. Again, not expensive at all, maybe near-term oversold. You see the S&P 500 below that in the black line. And as I mentioned, we're trading below the 5-year average. We're trading ever so slightly above that 10-year average, as you can see here. But if you go down that list and you look at these different kind of factors that typically get analyzed and scrutinized, we've already talked about small caps at the bottom. We know that those are grossly undervalued relative to their 10-year average. But also, when you look at dividends and momentum and equal weighted, which we've talked a lot about this year, again, the Magnificent Seven have led the way, and the rest of the market has kind of lagged behind. And you can see, when you look at the market on an equal weighted basis, it actually is relatively cheap to its 10-year average. And so these factors that are typically stronger performers when you get into an economic slowdown are actually cheap right now. Now we will take a look at next 12 months price to earnings ratios over the last 3 months. So this is kind of a view for the third quarter and what happened during the third quarter when we had this sell-off. And you can see here that virtually every area of the market was impacted from a factor standpoint. You can see the S&P 500 here in the black line. So obviously as stocks sold off, price to earnings ratios went down, which is healthy, if you're looking for opportunities to buy over the long term. But you can see here that just straddling the S&P 500, that both value and growth sold off meaningfully. And so you've got these price to earnings ratios that had a fairly decent reset, over one multiple point in either case. But dividends tended to sell off a little bit more, which is a bit ironic. If you're assuming that you're heading towards an economic slowdown, that you certainly want companies that pay dividends, because they indicate that they kind of suggest that there are companies that are strong enough to pay dividends and that they are strong enough to kind of weather the downturn a little bit better than most. But just about every area of the market, just to be clear here, did participate in this multiple contraction, whether it's equal weighted, whether it's small caps, whether it's even the high beta, which means the stocks that tend to react fairly violently when the market moves both up and down, and even quality, sold off in this environment. So it was an interesting quarter from a market dynamic standpoint. It did create some longer term investment opportunities, as we've talked about, relative to that 10-year average. And it certainly created some opportunities in those areas that we feel will be more resilient in an economic slowdown. Here we have a chart that pulled out of Goldman Sachs. I thought was pretty interesting. And it shows when you hit a peak rate of interest, again, the Federal Reserve, we think, is pretty close to the end of its rate tightening cycle. But if you hit that peak and you have, along with that, a fairly sharp rise in yields, which we have had, and positive equity bond correlation, which we have had, that just means that equity prices and bonds are moving in the same direction, that typically after that point, you have better performance in the equity markets, both from the S&P 500 standpoint as well as NASDAQ 100. And that's depicted in this chart on the left. Now on the right just kind of shows you what that number would look like if you didn't have any conditions, put on it. You're just like in any one given month during the last 40 years, that this might be what you see. Talk about bonds for a second. We just mentioned that bond yields have gone up. Here we've got the 30-year U.S. Treasury, and we've reattained yield levels above 5% that we haven't seen since 2007. This is a fairly tectonic shift in interest rates, which has really prompted the equity market sell-off. And when you think about yields moving higher and prices moving lower, that's the inverse relationship with fixed income. That's what I mean when we talk about the correlations between bonds and stocks. So when yields move higher, bond prices go lower, and we know that the equity market has sold off. And so that's where the stocks and bonds are moving in the same direction right now. This is a chart of new issue yields for high yield, and you can see the impact of higher interest rates. And very notably here over the third quarter, we've seen a bit of a bit of a continuance of the higher overall trends that we're seeing now. What's interesting about this chart, and you can see the aggregate levels on the y-axis over there, that they're kind of coalescing around 9%. And you think about where treasuries are trading right now, the 10-year. And so you've got that spread between those two, and that's actually been fairly tight. And so this is something that you feel like if you're going to be in an economic slowdown, then the risk of default ostensibly increases. And so the yields on these high yield bonds would tend to go up. If you're going to have an economic slowdown, you've got more economic stress. But right now they've been pretty tight. And so we'll have to watch this right now. What you see in yields and spreads and high yield right now is certainly not indicative of a major economic calamity that would be on the horizon here. We have a chart showing you the number of banks, or the percentage of banks that are tightening their lending standards, and it's going up. And we know that. We've talked a lot about the commercial real estate sector, and we know where the stresses are there. But this also relates to consumer and industrial loans, working capital loans, all of the above, really. And so you can see here that these standards, these lending standards, are getting a lot tighter. Here we have concerned loans as a percent of the overall market. And so this is from Fitch, and it ties in with the last chart. And so, we just see a little bit of incremental stress here in the market, where you've got loans that are under watch amidst tightening standards. You see the whole banking sector and the whole credit sector is beginning to tighten up a little bit. Now, people can still get loans by going to private capital and private debt. Those rates are very, very high, and in many cases onerous for businesses to take on. But the conventional banking market is getting tighter, and that is usually a precursor to slowing in the economy. Turn our attention to household savings. I've got a couple of charts here that I think are pretty interesting. This breaks it down by income cohort. So you can see the amber line represents those households making more than $100,000 a year. And you can see savings and checking balances and this is an index. So you can see that is beginning to trail down. So we had a lot of stimulus payments, and that has led to a lot of consumption. It has led to some excess savings, which we'll talk about. But we can see that number is meandering down. And this is something that we expected. This is something that we've been observing and talking about for many months now, but it's just one more data point in confirmation of that. Here we have real excess savings during the pandemic. Again, goes back to that last slide that we just saw. Pandemic happened, stimulus payments. We have a bump in excess savings over 2 trillion, 2.25 trillion, in fact. And what's interesting here is we know that those savings are coming down. And so not too long ago, we felt like that number was like 500 million after being somewhere closer to 2.5 trillion. Now we have revised that a bit higher right now. So it's maybe about 40% of where the peak is. But that's after looking at several different factors. I won't go into those, but directionally, I think it's still important to mention that excess savings are going down, and this has been kind of the impetus behind consumption. And so when you exhaust these excess savings, that's when you begin to worry about consumption, which is 2/3 to 70% of the economy, which then obviously would slow things down. But we know money supply is negative right now, so money is being pulled out of the economy, and then you've got these savings that are being drawn down, and so really the mother's milk, if you will, for strong economic growth is being pulled away gradually over time. Here we have a breakdown of net worth trends on an incremental basis. So you can see, net worth in the red, and this is in trillions of dollars, and you can see the components of that, and really what the drivers are when you have changes in net worth. And we know that at various times the stock market, which is in that blue, mutual funds, equity shares, when they're negative, it pulls down net worth. Real estate, we know, has been a strong contributor to that growth, and we've actually seen that here over the last quarter. And pension fund reserves to a lesser extent, but you can see the trends in net worth here have been entirely positive over the last couple of quarters, helping to improve investor sentiment to some degree, consumer sentiment to some degree, and helping to massage those economic numbers to where the data itself has really not been that bad, and kind of added to the confusion of, well, wait a minute, we've got higher interest rates. Why don't we have a slowing economy? Well, at least not yet. And a lot of these things, a lot of the reasons why are embedded in this chart, that real estate prices, home prices have gone up, so on and so forth, and we've had net better performance out of the equity market this year than we have last. So a couple of things that people are watching: food and energy. Again, those are the parts of the consumer price index that get pulled out to, when we scrutinize inflation, we say, oh, well, core prices are, so and so. Well, we pull out food and energy, and, energy prices are likely to remain higher for a bit longer. But what we see here is on the wholesale gasoline side, those prices are coming down. They're not likely to drop like a rock. And again, I don't want to maybe oversell this chart perhaps, but retail gasoline should follow wholesale at some point. And we know that energy prices on balance are elevated, and because of the geopolitics that stand behind that, likely to remain higher. But at least we should get some relief in the fall here, as we're kind of changing over blends, that we should get some relief, a little bit of relief in gasoline prices. Here we have milk and eggs, not all encompassing by any stretch, but as we kind of look at food prices in general, and we've kind of talked about food prices having come down, I think that is clearly the case, although, to make no mistake, I think this is a proxy for what we see across a lot of different categories, is that prices remain elevated relative to kind of the 5-year historical backdrop. They're just not at their peaks. And, of course, eggs had its own problem, and that was not related to, maybe, economic reasons. That had more to do with, the health and, some issues with flocks that had to be put down, and so on and so forth. But you can see here, coming off the peak, but still has a long way to go. We'll switch to employment for a couple of charts here, and we have, we had the jobs report last week, and we had the biggest gain since January. We were at 336,000 jobs. So we know that the unemployment rate was at least steady at 3.8. So that is up from its low, but it's still on a relative basis very low when you look back over the last handful of decades. But you can see here the employment changes for different surveys, if you will. We've got the household survey. We know that the employment levels are coming down there, and the employer survey seems to be a little bit better. We've got some interesting looks at job creation and small business that are coming up in future slides, but you can see labor market on balance is kind of slowing down, but it's so slow that if you're not looking at a chart like this, it may seem somewhat imperceptible because the labor market is, in fact, still pretty strong relative to what you'd expect if you're going into an economic slowdown. Here we have National Federation of Independent Business, NFIB, hiring intentions. Again, those are flatlining a bit right now, and we see private payrolls that are also coming down a little bit here too. So this is all indicative of what the Fed is attempting to do in engineering this slowdown. So, try not to crater the economy by raising interest rates to combat inflation, and in doing so, try to engineer kind of a soft landing for the labor market because labor's been hot. We know that obviously wages, which are very important to the cost of services and even to some degree the cost of manufactured goods, have been elevated. But we can see here very clearly this downtrend, which is healthy if you're trying to engineer a soft landing. Now, you certainly don't want to see this number just like drop to the floor or or go negative here. But if we continue along this trend, this is very consistent with what you would hope for in a soft landing. Here we have wages and prices, and you've got the consumer price index and the dotted black line there. We know that we've had many, many months of progress there, and then the overall consumer price index just kind of perked up a little bit. Again, nothing that I would feel like we should be panicking about to any degree. And wages, as I mentioned on the last slide, are extremely important to service inflation, which is really where we see a lot of the impact in prices is on the service side, where we see price inflation. And so if you look at weekly wages and hourly wages, those continue to trend down. They are relatively sticky, which is very much what you'd expect. Wages and rents are the stickiest components of inflation, and you can see here that they are kind of stuck close to that 4% level, but they are coming down, and we want to continue to see progress here. Oh, I have a comment here about the workforce. A couple of data points here. We've shown you the chart on the left. That's a share of the prime age working group that is employed. And so, without a doubt, we had a dislocation with the pandemic, and then we've recovered up to above where we were prior to the pandemic. And you can see how it is somewhat cyclical. When you hit recessions, you tend to roll over in that participation, and we're just now seeing that those data points kind of level off. You've got the prime working age that's in the labor force that is available to work, and we feel like there's more people that are out there that can come into the market, and you can see that on the right-hand side, which is the participation rate amongst that key group, 25 to 54 years old. And you can see that we were at about 90%-ish in September. So, we've come a long way, but as you can clearly see from the 80s and 90s, that we're still well below the levels that we experienced then. And I think what that tells us, frankly, is that that there's people that are out there that can come back into the workforce when they feel like conditions are better. And I think that is absolutely helpful to labor market conditions. Maybe you have the ability to soften up wages a little bit more because your supply of labor is in effect higher than what it's being calculated as because participation rates are a little bit lower. Quick comment on trade balances. Trade deficit was down, and it's the lowest level that we've seen in a little while here. And I think this is really good news. What's interesting is that we've had a really strong dollar, and you think about what a strong dollar represents means that foreign buyers of U.S. goods experience higher prices when the dollar is stronger. They have to pay more, right? And so that tends to soften demand. But we've had greater exports of things like energy and fewer imports of things like technology, cell phones, for example. And so that net effect is causing that trade deficit to fall despite the normal headwinds that you'd see from an export market from a higher dollar. Here we have an ISM quick check-in. It's actually somewhat current encouraging. Now we've talked about that manufacturing number going negative, and you know how that was casting a pall in the overall market, but we've actually seen it turn up. So as we sit here like talking about economic slowdown, you know, I certainly wouldn't expect kind of this little fish hook in activity here from the ISM manufacturing number, but it is happening. We can see that overall index is still below 50, which means anything below 50 is in contraction. So that technically is still in contraction, but we see production and above 50, and we see new orders moving higher as well. So we'll switch to the ISM Services PMI. The last slide was talking about manufacturing. And here we are still above 50. Now, it's, you know, you can argue as to where we're going directionally, but the overall services PMI is about 54. And so you can see that jockeying around a little bit, but you know, that still represents expansion. And then on the right-hand side, we've got new orders that has certainly have moved down, but they're still above 50. And so, you know, if you look at kind of a longer-term trend line in service PMI new orders, you can see it does appear to go down. You know, it's a negative slope there, and so we'll have to pay attention to that as we get into the latter months of the year. But just to be clear, it's still positive and evidence of expansion in the economy. We have manufacturers' new orders. If you back out transportation, and this is a monthly data, so I guess we're moving back into manufacturing. You can see again to kind of like support, you know, my comments there a couple slides ago. Manufacturing orders moving higher. I thought it'd be neat to turn our attention to the emotional well-being. This is kind of like a sentiment indicator. Found this in the Daily Shot. Kind of speaks to a couple of questions that I had in my mind. You know, we talk about higher prices at the pump. We talk about higher food prices. You've already seen that those are coming down, perhaps, but still pretty high. And so, you know, how does everybody feel, right? I mean, you got you know, you hear the data about inflation coming down, but if you're paying more at the pump, it doesn't feel that way. And you can see here in the upper chart here that you've got, you know, the emotional well-being index that's moving down. And so sometimes that can be reinforcing if you start to feel less positive about things, then you maybe start not spending as much, and so it becomes kind of a self-fulfilling prophecy. Now, you know that is moved down over several months now, so it is worth noting. And then down below, you can see the impact of the resumption of student loan payments once that moratorium is lifted. Actually, I guess the announcement of the moratorium going away happened in June. You could see that in that blue line there below that you know, once people with student loan debt heard that, you know, then their perception of things went down, whereas everybody else you know, it seems to be meandering sideways to down. So you know, this is it's a pretty interesting and compelling data point here that you know, when we talk about the impact of student loan repayments, and I've shown you some charts recently on the impact on economic growth, and maybe it's, you know, 0.5%. We don't really know because something like this hasn't really happened before, but clearly the sentiment is a little bit lower on the part of these people. I want to talk about something that has a little bit more of a long-term, long-tail impact, and that's the budget deficit and government spending and what have you here. And we know that the deficit is is fairly strong relative to history. Certainly not as big as the pandemic. We had all the stimulus payments, but is creating a huge political football in Washington, and obviously we got this continuing resolution which kicked the can down the road for basically a little more than another month, and then we're gonna have to wrestle with this again before the holidays. And I honestly am at a loss to see where we're going to go because we don't have a Speaker of the House, and I know that creates some uncertainty in the markets. But however you cut it, this deficit is higher than it has been, and it may not feel significant now, but it adds up over time, and then it creates runs the risk of creating a situation where you have a lot of leverage, and we know that we're increasing our national debt relative to the size of our economy, and over time that just creates a situation, if unchecked, that tend to have slower overall growth in the future. And some of that is natural. It comes as a byproduct of a maturing economy, the law of large numbers, but also you can also dig a hole for yourself by doing what you're doing in this chart, and that's increasing your deficits. Here we have net interest on federal debt. Now we know the debt itself is moving higher, but we also very well know that interest rates are moving higher. And so, this is something that, is important for me to follow and talk about a little bit because, the equation for GDP, for gross domestic product, is C plus I plus G plus X. And what does that mean? It means consumption plus investment plus government spending plus net trade. And so, the G in that is government. And so, when you think about the ability of government to fund discretionary expenditures, it becomes a lot harder when your interest burden is moving higher. And so this is a long-term forecast, just mind you, and this is from the Congressional Budget Office, and it looks out like 2050. But directionally, it's impactful in the sense that, for the last decade, it's been maybe 1.5% of gross domestic product, and you can see that moving higher. And as that moves higher as a percent of the federal budget, then it crowds out other kinds of spending. And so that's what I think is maybe an important takeaway here that we all need to be worried about. And I think it goes back to, without waxing political, it goes back to doing what we can to be fiscally responsible with our budget deficits, because government spending as a component of our economic growth is actually pretty important. Here we have another view of that. I thought I'd show something that doesn't go out necessarily, as far as 2050, but maybe has a little bit more of a near-term impact. And you can see, that our actual net interest payments from a percent of GDP kind of flatlined there until we hit the aftermath of the pandemic, and that we're moving higher. And so we've got Goldman Sachs in here making some estimates and revising those estimates, and obviously those are moving higher. And so when you think about a 20 plus trillion dollar economy, moving from 2 to 4.5% is very meaningful. I thought I'd inject here a little bit of good news. And here is U.S. business applications moving higher. So these are, ostensibly smaller businesses, but new business creation, which has the potential to increase the number of jobs and provides kind of feedstock for future growth. Even as we're sitting here talking about maybe a slight uptick in delinquency ratios and slight uptick in bankruptcy filings and Chapter 7s and so on and so forth, that on the other side of the coin, you've got new businesses that are coming into being, and that is going to be a really good engine of growth when we get through this slowdown and hit the next side. Here's a slide from Oxford Economics. I have not seen this. I've seen both of these indexes before, but not overlaid together, and it's remarkable to me how much correlation there is between the two. And this is measuring consumer sentiment in the blue. So, uh, when that line moves up, consumer sentiment is stronger. And then that's overlaid with the misery index, which is inverted. So, and misery index is a simple addition. It's a simple math, problem. It's just adding unemployment rate to inflation. And so, when you think about it, when unemployment and inflation are both low, your consumer sentiment is pretty high. That makes a lot of sense, right? And so, right now we have a pretty interesting gap. So, I mean, we have relatively low unemployment. We know inflation, which has been a lot higher, has come down a lot, and so that number right now is about, it's between 7.5 right now, and you can see that on that inverted scale on the right. But we have pretty low consumer sentiment, and so that sentiment should be higher right now. And so it's just an interesting observation, and I'm not sure, what implications it has for where these two are eventually going to meet. But if you go back to 2002, it is pretty clear that they overlap pretty tightly. And so either you're going to have unemployment rate come up, or you're going to have consumer sentiment eventually move up. And if you have a soft landing, I would certainly bet on the latter, especially if we know that we're towards the end of the rate tightening cycle. And here's an interesting slide from Brown Technical Insights. It shows you if the S&P 500 is up at least 10% year to date through July, but down in August and September, that in those instances that have been measured since 1961, that in every case the fourth quarter has been positive in terms of the total return for the 3 months. And so, we were down about 6.6% in August and September in the markets. So we definitely had, as we've talked about very earlier in the slide deck, that we've kind of unwound some of these gains that we saw earlier in the year. But if it makes you feel a little bit better that when we've been in this ballpark, so to speak, where we've had that positive first half return, and you can see here that the prior instances where these little reverses have happened, the first half of the year has been really strong. And so we gave up 6.6% in August and September in the S&P 500. And that in every instance measured since 1961 that the fourth quarter has been positive. So obviously there's a big question mark there. The average return in the fourth quarter has been about 9.5%. So again, this all ties back to this issue of, are we going to have a soft landing? Is the Fed not going to make a mistake? And if that happens, then there's certainly the odds-on chance that we're going to have a really good market in the fourth quarter. Well, as we conclude the slide deck, probably shouldn't have ended on this one, but it's something that is going to bear watching. And this slide kind of refers to the health of the commercial real estate market. And so, interest rates we knew moved up quite a bit earlier this year. That caused a lot of stress. Silicon Valley, well understood, well documented. And then we've had this recent uptick in interest rates, and it's clear that a lot of banks haven't been able to really address their balance sheet issues. And so as interest rates move even higher, then that puts more stress on the commercial and the regional banks in particular. And you can see here their balance sheet in the upper left-hand column, or the upper left-hand part of this chart. These are securities. This is their balance sheet. These are their investments. And so the carrying value of those investments has gone down because interest rates have moved higher. And you can see as a percent of bank equity capital that that's an issue, and we should be aware of that. Now, if you go over to the right-hand side, I turn your attention to the right side of this, which are these small banks and the texture of their loan book right now. You can see it's much more heavily influenced by commercial real estate. We know with higher interest rates, cap rates have moved higher, which reduces the carrying value and the marketable value of real estate properties. And so, when you've got commercial real estate loans that need to be rolled over and values are lower, it creates a stressful environment. So I guess I don't want to say that I'm panicking by any stretch. I think what this is going to lead to is subtle yet pronounced um, consolidation within the banking sector. And we have 4,000 institutions out there, and it's going to, I think we're just going to have some consolidation coming down the pike. That's all we've got. Hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.